Hello, welcome. Happy New Year. Welcome to the live Mayar Capital Q4 Q&A. My name is Libby Ross and I'm Senior Sales and Client Relations Manager here at Mayar Capital. I'm delighted to be joined today by our founder, portfolio manager and managing director, Aziz Anaim, and by our partner, head of research and deputy portfolio manager, Aubrey Brockle-Blank. We hope you received the recent full year letter, which focused on the theme of us sticking to our knitting, which is focusing where we got distinct advantage and being disciplined in our process, staying patient. Today's session is designed to answer your questions. So at any time, please enter them into the chat and we will endeavour to answer them. Thank you to those who've already submitted questions, and we've had a whole host come through, and that's where we're going to be starting our discussion. So moving on, let's start with our first question. Always grabbing headlines is Donald Trump. And despite his promises to end wars, the person is asking, he's orchestrating many of the world's struggles. What is the impact on the dollar and equity markets in your view?
Where do you start with this one? I think it's going to be a very long-term impact. So I think any things that we're seeing right now are probably only kind of the tip of the iceberg. One thing that I noticed recently, just over the weekend actually, is I saw a report that that's indicated that the balance sheets, the reserves of central banks globally of gold have just exceeded the total amount of reserves held in treasuries for the first time, or the first time in a very long time at least. So central banks are acting in a way that says we do not trust the dollar, we do not trust the United States, and we want to diversify, we want to hold more gold. And the reason that gold has doubled over the past 12 months is predominantly because of that, because of central bank buying. So I think we're going to see a lot, and we've heard Mike Carney's speech at the World Economic Forum last week, which I think is an excellent summary of where we are in this world. And I think this is just the beginning, unfortunately. I think there are going to be long-term ramifications that have yet to be seen.
Well, I mean, let's just have a quick counterpoint to that we have the midterms coming up, which could effectively turn Trump into a lame duck president. And, yes, there are some long-term ramifications, but these could be, a lot of the things he's done could be undone in the not too distant future, over the next few years. And, the thing is, the American economy has proved so resilient for so long that, I don't want to completely bet against it. I don't want to be overweight it, and I probably don't want to have market weight, given how extreme the allocation the MSCI World has to the US. But it's still an amazing economy, and a lot of the businesses there will not just survive, but continue to thrive despite whatever he does.
I agree with you, Aubrey, on that point. I think when it comes to a lot of these businesses, I think they'll be fine for a while. My worry isn't next year or next 3 or 5 years for that matter. I think when I'm talking about kind of long-term ramifications, I'm thinking more about 20, 30, 40, 50 years. I think over the long term, we will look back at this moment, and I think they're going to be in the same way that the arc of history takes a very long time, and that doesn't, the small changes in the arc of history only shows up in hindsight because of that. I think this moment will probably be one of them when we look back. But like you said, if things get reversed very quickly, then I think maybe this turns out to be a blip in the longer term arc, as have been many. America has had many of these crazy situations in the past. It's not the first time, and some of them were actually worse than this one. So maybe this is just a blip, and things will go back to the long-term trajectory. We'll see, I guess.
Yeah, and I suppose a question that follows straight on from there is, do you agree that China has shown more resilience in facing US trade wars than many had thought it could?
Yes, definitely. I remember reading about this in 2018, during the first Trump presidency, Xi Jinping kind of put together a task force that said, how can we become more resilient and independent from the United States? And 10 years later, China was prepared when this happened. So I think there are many things that are negative about the Chinese system, politically and economically. But one thing that is certainly clear, that is positive, and that is unfortunately has been missing in the West in more recent history, is that the Chinese have been able and still do think long term. Instead of thinking just what's going to happen in the next 3 months or 6 months. So China has been preparing for this moment, and what we saw in terms of how resilient they are is not an accident.
I mean, I think the only thing to add to that is that the other factor is that a Chinese political system has a much greater ability to withstand pain than a US system.
That's for sure.
Democracy, does not lend itself to being able to withstand pain very well.
I suppose this question is more focused on Mayar. Question is, what is the biggest misconception investors currently might have about your portfolio or investment philosophy going into 2026?
Interesting. That's a very interesting one. I think one misconception could be that we don't like growth companies and we don't like technology. And I don't think this is true. I think it's a misconception about where things stand today, or the way that we don't like the US and then we only like certain types of businesses. In the end, our job is to make an investment decision based on the information that we have that will help us kind of try and look at the future and see whether the price we pay today is low enough to protect us from the scenarios where what we want to happen doesn't happen. So I think this is kind of the core of what we think. And I think the misconception is people think that we'll just fixate on a certain low multiple or something like that. And that's not true. The way we think about it is we're going to think about 1,000 scenarios about the future. And we want to pay a price where, I don't know, 70% of those scenarios do not produce a permanent loss of capital for us. And kind of this is how we, at least, I think this is how I think about what value investing is, in that there are going to be many versions of the future that we don't know. And we just want to make sure that in the overwhelming majority of them, we do well. And in the ones where we don't do well, we don't do too badly. And today, in the US market overall, and certainly technology stocks, it's the other way around, where the overwhelming majority of scenarios in the future, you don't do well. And in a small minority or a decent minority of scenarios, you do very badly. So it's a flip of what we like. And so I think that's probably one big philosophical difference. I don't know, Obi, I may have kind of rambled too much and maybe you could put it.
I think that's absolutely right. People seem to think that we don't like tech, where we do, but also people think that we're not necessarily exposed to tech. But we are, and sometimes it's directly. So, for instance, through Capgemini, where we believe that the sort of consultancy and systems integration element is essential to any corporation actually implementing AI, in any widespread sense. But then we also, have exposure in other ways that, well, actually, recently we sold down a bit of Richemont. Now, it may seem odd that we'd say that that's exposed to tech, but actually the wealth effect in the US has been so driven by tech that this means that people have been able to buy, bracelets, necklaces from Cartier, and watches from Cartier. So when we look at our portfolio, we actually do see exposure, but often it's not direct. And So we, again, as you say, try and balance it. But I think the other misconception investors do sometimes have about us is that they don't. I just wonder if investors fully appreciate that there is a dual mandate for active fund managers: outperformance and reducing risk. And these are two things that we have to balance. And it's very easy to see out or underperformance. But measuring the risk we take is very, very difficult. And you can't measure it simply with volatility. Volatility is one measure that helps, but it is one of many measures. And most of the ways to really look at it are very much theoretical. It's when we think about what is the downside to our portfolio and to the market and to other stocks, this is our estimate of what we think might happen in the future, or what might have happened. And we take lower risk than the market. Now, sometimes that pays off for us and sometimes it doesn't. But we want to preserve the absolute capital value of our clients. We want to preserve our clients' capital. That really is the most important thing. And I think just sometimes it's not easy to see how we actually do that. And it's impossible to measure what might have happened but didn't happen.
Yeah, I think that's a great point. I think this reminds me of that Joel Greenblatt quote, where it's like, just because you run through a dynamite factory with a lit match and survive to tell the story doesn't mean that you're not an idiot. And this is the problem with risk, is after the fact, you only see what happened. You don't see all the other scenarios that did not happen. Over long periods of time, if you keep doing stupid things and taking stupid risks, you eventually blow up. But that only shows up over a 20, 30, 40, 50-year time frame, over any short period of time. And even 10 years is a short period of time in a probabilistic sense. The risks you avoid don't show up kind of in the track record. I'd like to add actually one more thing in terms of misconceptions, which is a conversation I've been having. I've been in Saudi for the past couple of weeks, and it's a conversation I've been having, which is that people think we somehow don't believe AI is real and don't think AI is going to be revolutionary. That's absolutely not true. We do think it's real. We do think it's revolutionary. We do think it's going to have a big impact. Our issue isn't with AI as a technology. Our issue is with the evaluation of AI stocks these days. And just like the internet changed the world in the 2000s and up till today, we think this is going to happen again with AI. But it was equally stupid to buy a basket of internet stocks in 1998 and 1999. So there's a distinction between the stocks and the technology and the businesses that are involved. So I think that's also another misconception.
No, absolutely.
Well, we have a next question, and this isn't essentially in our portfolio, but the question is interested in your insights on gold and Bitcoin for the year ahead.
I've got no insights. I think nobody knows. I think I've mentioned earlier the thing about central bank buying a Bitcoin. We've been reading about it for a very long time, but I'm just shocked by the magnitude of it just in the past few months. Is it going to continue or not? I've got no idea. I've noticed just how widespread retail buying of gold has become the past couple of months. The other day, I got an app notification from one of the banks here in Saudi telling me that it's now so easy to buy gold. I can buy it from the app for my checking account. So that's usually not a good sign, but on the other hand, the world is such a crazy place that we can continue to see people buying gold just as a hedge against that. And the reason is when that, it hits the fan, people kind of go back to what they've known all along. And one of the things that human beings have liked for a very long time is the shiny metal that does nothing, but you can carry it in your pocket and makes you feel good. So as long as that human instinct is there, and it's been there for a very long time, I think people will buy gold when they're worried. So, but I have no idea of what's going to happen next 12 months, and I don't have a framework for even figuring out how to predict it.
Well, that does remind me of the Jim Simons story of, he the founder of Renaissance Capital. Way back before Renaissance, he made a fortune trading gold because he realized it was overpriced when retail shops were setting up in order to buy gold, and people were queuing in order to sell gold rings and earrings that could be melted down. And he realized that that had to be a bubble. But I don't think that necessarily plays out here. There are very different dynamics. I mean, with Bitcoin, I have noticed that it's been touching a resistance level at 90,000, and were it to fall from there, it could easily go to 50. But if you want more, technical advice on that, you're probably just as well checking your horoscope as asking me.
Well, maybe we could turn to US companies. And the question is, could you provide a sort of broad earnings outlook for US companies?
I mean, the one thing I can tell you is that late in an economic cycle, when we look back at things, there's a consistency of the sell side to overestimate the earnings growth of US companies or any group of companies. I think the US economy has been exceptionally resilient, surprisingly. A big chunk of that has been driven by AI infrastructure spending. So actually consumer has been weakening the past couple of quarters, but AI spending has picked up that slack. So I think that's going to be a big delta in terms of the economic activity. And it's not widespread. So we've seen pockets of strengths and many pockets of weakness. But I think one of the things that US companies have struggled with kind of last year and the year before has been the increases in interest rates. And that coming down should help them collectively, at least. I think the big unknown as well is what happens to tariffs. We've yet to hear from the Supreme Court. I think the Trump administration, even if the Supreme Court rules against them, will find another way to impose those tariffs. So the tariffs have been pretty significant for at least certain types of companies in the US. But so that's another thing. So I think it's a point of extreme uncertainty. I think there's always uncertainty when predicting earnings over 12 months or for that matter, longer term. But I think there are just a lot of balls in the air now that make it exceptionally difficult. I mean, luckily we don't make these predictions and don't need to make these predictions. We focus on our knitting, we focus on the businesses that we like and own, and do our best predicting those within a very wide range of potential futures. And we buy these companies and own them only when the price makes sense in a lot of these scenarios. Aubrey?
Yeah, so I certainly, subscribe to the theory that the US has a K-shaped economy, where the wealthiest Americans have been doing exceptionally well, but actually a huge proportion of Americans are actually really struggling. And we're seeing this in a lot of consumer stocks, in a lot of stocks, anything that is not exposed to luxury and not exposed to tech, or some indirect beneficiary. That strength has really been masking a lot of pain for a lot of traditional great businesses. Actually, a little shout out to my brother's market research company. He's been doing quite a bit of work on this, and his data points are just seem to be showing all this to be very true, and that there really is a lot of difficulty, at that point of the market. But at the same time, look, this gives us an opportunity to buy some of these businesses at depressed valuations, at trough earnings, So, we have to sort of look at it with some optimism for our portfolio.
Aziz, you've written in the most recent investor letter about the likelihood of a market correction without predicting any timing. How do you expect the portfolio to behave if such a scenario was to unfold?
Well, I think history teaches us that we're going to have a market correction every couple of years and a bigger one every 5 to 10 years. And so it's not a stroke of genius for me to predict that there's going to be a market correction at some point. And we've had a big run up and valuations are high, so that increases the probability that happens sooner rather than later. But it's just the nature of markets that you're going to have these from time to time. I think historically we've demonstrated that our process and strategy is very resilient in these situations. And I think I mentioned in the letter in the 20-something years that I've been running the strategy, when the market goes down by 10% or more, we usually our portfolio holds up fairly well and only goes down by 70-something% of that. So if the market goes down 10%, we usually go down by 7 or 7.5. And then actually the bigger the drop in the market, the better our portfolio holds up. So I've always liked that aspect to it because it protects our capital on the downside. But the other thing is it gives us, because we've protected our capital, it gives us the opportunity to buy businesses that we like, that we've always followed and just never got the chance to buy at depressed prices. So it's a great place to be, to have capital that's been protected and cash on hand when the market is down. So I think that is going to continue to be the case. We've seen it in March and April of 2025, just how well the portfolio held up. There was a very short-term decline in markets, but when the markets were down almost 20%, we were down in the single digits. So we managed to protect our capital. I think that will happen again. It's basically the nature of what we do, and it's actually a huge advantage that we've always had. And a lot of the alpha that we've generated over time has come from that. It's come from us protecting our capital during downturns, and then us being ready and able to aggressively buy at depressed prices. This kind of is the DNA of what we do. We just haven't had a big drawdown like that in a while, but it will come, and when it comes, we will be ready.
I think maybe the other thing to add to that is that if there is a market correction, it is very path dependent. Yeah, and broadly speaking, there are two types of correction we could get. One is that it's very localized in AI and it replicates the .com correction or crash much very closely. But the other is that you have a much more sort of economic collapse or crash, and that would be different. That would be sort of what you've been talking about, just now, where the market goes down 20, 30, who knows, 40, and we go down, by half that amount. But if it were to replicate the .com crash, and it were just tech, just localized in tech, we could easily see a situation where, given concentration levels now, where the market could be down 30, 40%, and we could be up 10. I'm not making any predictions here, and I'm certainly not saying that that's what's going to happen. But if you look at what happened during 2000 to 2002, we saw the market down 40, and at the same time, a selection of boring but good businesses were up 10, sometimes 20%. So that is very much a possibility, and obviously that's what we hope happens, but we prepare for all eventualities.
Yeah, and I suppose drawing on that word boring you just used, Aubrey, but I have a question. It's when you look back at your most successful investments, how often did they feel boring at the time, and what characteristics did they tend to share?
Well, that's a It's a very deep question. I think we can spend all day discussing it.
Well, I don't find them boring. They're not boring to us.
Yeah.
We
The
find ovens and nurseries exciting.
mantra is boring is beautiful.
Well, I think we do say boring beautiful. There's a bit of tongue in cheek when we use it. But I guess it's boring in the sense that it's not something that if you're in a gathering of professionals or the classic cocktail party situations, whatever, it's businesses that people are not likely to be talking about in a social gathering. People will be in a social gathering and they'll be happily talking about NVIDIA, this or whatever tech company that they own at any moment in time, or a new technology or new biotech. People are very unlikely to be talking about equipment rental for roadworks or construction businesses or anything of the sort. They're equally unlikely to be talking about I don't know, what's another boring business that people are not going to be talking about? What were you thinking?
Well, Bright Horizons, nurseries, Croda, specialty chemicals.
Yeah.
But not just that. What is boring now is not necessarily boring 10 years ago, and what is boring 10 years ago is not necessarily boring now. I mean, 10, 15 years ago, people probably wouldn't be talking about Microsoft as an exciting stock. In fact, it was trading at 6 times earnings. People thought it boring. Oh God, Windows and Microsoft Word. No one saw the sort of nascent cloud business and everything else that they were doing, and how brilliant a business it was then. So things change as well.
I think the other thing is people underappreciate. If you have a business that is growing its top line by, I don't know, 8 to 10%, nothing extraordinarily high that people think it's the next new thing. But it's been doing it for decades and decades. And they gain a bit of scale and margin improvement over time, that translates into double-digit performance at the net income line. And then you get dividends or buybacks on top of that. You can generate mid to high teen returns from what looks like fairly mundane levels of growth. And even that 8 to 10% revenue growth rate could be, 3% volume growth, 3% price increases, and 2 or 3 percentage points of new customers. So they don't look like big numbers, but over long periods of time, if you continue to execute time and time again in these boring businesses, that translates into pretty extraordinary results over decades. And we just have a preference for these types of situations over something that is going to make, 25% growth a year over a 10-year period, but then by the end of it, it gets disrupted because something else new comes into play, and there's nothing resilient about it. This is why the average age of companies in our portfolio is something close to 80 years. There's something to this longevity that I think that makes it more likely to continue than the other way around.
Well, absolutely. It's sort of like actuarial science. If you live to your probability of living from 60 to 70 is the same as your probability of living from 70 to 80. The older you are, the better your chances are almost. But I think 2 companies that sort of really exemplify this would be Middleby and NVR. Neither company has done better than low double-digit growth, low teens, sometimes high single digits, or often high single digits. Again, a little bit of margin improvement. Never traded at neither of them have traded at crazy multiples. But Middleby is a 100-bagger. If you'd owned it for 25 years, you'd have made 100 times your money. NVR, I think you'd have made about 1,000 times your money. The numbers are extraordinary. What a brilliant business can deliver over 2-3 decades is just absolutely extraordinary.
And Aubrey, I remember when you joined we've talked about LabCorp over the years, which is a stock that I've owned for, gosh, 23 years, I think now, or 24 years. And for most of that time, I don't think they've had many years where they've grown at 10% or more. I think they've tended to grow at mid-single digits to high single digits in terms of top line. And that's basically, again, low single digit volume growth, low single digit pricing, a bit of acquisitions, a good history of buyback. The stock never traded at silly multiples, so the buybacks actually go quite a bit. And for most of that time, it's basically done as well or better than the S&P 500 for all the excitement that's in the S&P 500 and all this tech this and tech that. This company that does pretty mundane. I mean, they don't think it's mundane, but basically medical testing. So where you take your blood tests, it's that type of boring is just extraordinary if it works and they execute over long periods of time. And it's that consistency of it and the risk aspect that Aubrey talked about earlier, that you can do these because you're not taking silly risks with these boring companies. If you just own a basket of them, you do very well over long periods of time. Not in any 1 year or any 2 or 3 years, but over long periods of time, you do very well.
Absolutely.
Yeah, and I think we should probably, as we're coming closer to time, maybe end with one final question. This is really about process and action. Where do you feel the team's investment process added the most value during 2025?
Oh, well, I think there's actually quite an easy answer to that, actually. And that's with the recruitment of Callum, or at least, well, his joining. So I think if you join a firm, and I mean, shame I should actually get him in here to answer this, but I think when you have a new joiner and they join a normal firm that doesn't really have a process, it's very hard to figure out how you fit in, where you add value, and to really get to grips with the house style. I know at previous firms, I've found that to be the case. Whereas, here, Callum has joined and has integrated so quickly and has become, incredibly valuable very early on. Now, a lot of that is that he's, an exceptional young man. But I do think a big part of that is actually that because we have this process, this checklist, he can look at it and go, okay, actually, next step is I've got to go and find out what the long-term incentive plan is for management. The next step, I then have to find out this. It's having a really structured framework, I think is really good, and especially for younger analysts, to give them that guidance. And, as they become more experienced, they learn how to flesh it out and learn how to, be a bit more advanced. But it has meant that he is much more valuable to us than he would have been if we didn't have that process. And I think for his own development, he's become a better analyst quicker than he would have otherwise.
I think Aubrey explains it extremely well, and I think that has been a perfect test and made me very happy to see just how well it's worked. I think the other way where in 2025 it really helped us is it's been a fairly active year in terms of portfolio turnover, and I know this has been brought up before, but when we have high portfolio turnover, it's not like I'm sitting here like doing these decisions like straight out of the gut, but it really is the product of the process. And in situations where you've got a lot of market volatility, you've got dislocation, you just see how the process produces these essentially almost automatic decisions, where it guides me as a portfolio manager on where to go in order to produce these outcomes. And I think I'm very happy with kind of the return that we generated in 2025, given that we owned basically very little US, no AI stocks, and still managed to generate a 15% return for the year. I think you can look at that chart kind of which is in the letter for how the portfolio behaved throughout the year, you'll see that we produced that 15% with very low volatility, and we held up very well in the two drawdowns that happened in March, April, and in November to AI stocks. And I think that's kind of the nature of it. I think it helps guide us so the portfolio evolves over time. So it looks like we're sitting and making these bets right and left, but it's not. It's really an evolution that is coming out of the process, and we're making small decisions every day that kind of guide the portfolio to maximize the best risk-adjusted return over time. And I think that is the output of what Aubrey talked about, which is the input.
Well, thank you. And I think that brings us to the close of today's session. Thank you both very much for sharing your views. We hope for those who are listening, this has been informative, it's been insightful. And if you've got any other questions you'd like to put to the team, please send them to ir@mayarcapital.com and we'll address them offline. Thank you once again for joining us.
Thank you.
Thank you.